So don't wait until the end of the session. Then after this discussion, so if you can, at least by tomorrow, you work out the activities in the course material. Right. Right. Shall we start now?
Of course, sir.
Right. Today you need a calculator. Right. So we are doing some calculations. Right. So your course is financial management. So you see, it's a management. Right. So it's management. But financial management. So here financial indicates financial resources. This indicates financial resources of a business. Right. So as financial management, what simply means is managing financial resources. Managing financial resources. So simply your subject area is managing financial resources. Basically cash. When you say financial resources, basically it's cash, but it has a broader meaning. So when you study this subject, you will get to know about that. Right. So the subject area is managing financial resources. So when you are studying this subject, we are usually relating to a business organization. Therefore, here what you are going to study is management of financial resources in a business organization. But concepts you are learning here is applicable even to other types of organization. For example, organizations which are not intended to make profits, not for profit organizations. For example, charitable institutions, societies. But when you study this course, we are usually referring to business organizations. Right. Now you have a basic idea. Financial management is managing financial resources of an business organization, of an organization. Right. Now let's take an example. Let's take an example and have a broad idea of this course. Right. Now let's say, right, you are going to start a business. You are considering starting a business. So you have to do a financial management. You have to do financial management. So you have to manage financial resources. You have to manage financial resources. So when you say management, you know it includes 4 management functions. Now, what are those 4? What are those 4? What are those 4 management functions? Right. So usually I expect you to interact with me when the discussion is going on, right? Because this is not a typical lecture. So this is a discussion, right? So you can talk to me. You can share your ideas. You can share your experiences, right? So simply now you know financial management is management of financial resources. So when you say management, that includes 4 management functions. Now, what are those 4?
Planning, organizing,
Yes.
leading, and controlling.
Yes, very good. Planning, organizing, leading, or you can say directing, and controlling. So when you are doing financial management, you have to do planning. You have to plan the financial requirements. You have to plan the financial requirement. So planning includes planning of financial requirements. Then organize. Organize means now once you know the financial requirement. So we look at one example later. So once you know the financial requirement, you have to find it out. You have to find money for that. Organizing. So raising money. Then you have to direct. Now you have the money. So you have to allocate money according to the requirements. Allocation of finance according to the requirement. Then controlling. So you have to see whether money is allocated according to the plan. So when you are doing controlling, you compare actual results with the expected results or planned results. Right. So as a management function, right? Financial management is management of finance. So that includes the 4 management functions. Right. So let's see simple example. Assume you are considering starting a business. So you have to do financial management. First, you have to identify the financial requirements. Think about you are going to start a garment factory. Now you have to identify financial requirements. So what do you need to start the garment factory? What do you need?
Raw materials, factory,
Yes, we need factory, very good. So we need a factory building. So land and building. Right. So you need money to acquire land building. So you need resources. One is land and factory building. Land and building. What else? What else? You need raw material, that's right. Yes,
Material, labor,
yes. We need labor resources. We need to recruit workers. Right. So that's so when the operations are started, so you need workers. But before that, first you have to set up the organization. First you have to set up the organization. So you have to buy a land and a building. So you have to buy some raw material. What else? What else? What else? Now think about garment factory.
bank
What?
loan, sir.
No, I mean, what do you need to start the garment factory? What are the resources you need? Yes,
Machineries.
you need. Yes, very good. Machinery. You need machinery, some equipment. I'm sorry, I couldn't get you.
And transportation, sir.
Yes, motor vehicle, motor
Storage,
vehicle.
store,
Yes, storage facility.
Infrastructure facilities.
Yes, that includes these items: motor vehicle, those transportation facilities, storing facilities. All includes the infrastructure includes all these. Right. Any other ideas? So you need resources.
Labor.
and workers, sir. Workers. Of course, we
Yes,
need workers.
yes. When the operations are started. Yes. What else? Before starting the operation, you need resources. You have to set up the organization, motor vehicle.
And money, sir. Of course, money needed, right?
Yes. Yes. To start the operation, you need raw material. You need some cash because you have to pay the workers. You have to pay for various expenses. Right. Now you see, you have to plan the money requirement, financial requirements. So let's say land cost. For example, let's say land is 50 million, building that includes factory building, store building, right? Canteen. So let's say 100 million, machinery 100 million, equipment 20 million, motor vehicle let's say 80 million, raw material 10 million, cash balance let's say 10 million. How much altogether? How much altogether? How much? Is it 370 million?
Yes, sir. Yes.
Right, 370 million. So this is planning. Planning of financial requirements. Right. So this is planning of financial requirement. So you have to identify the financial requirement. So these are the basic requirement, financial requirement to start the business. So total you need 370 million. You need total of 370 million to buy resources, to acquire resources, to start the factory building. Sorry, to start the business. So this is planning of financial requirement. Planning. Now you need 370 million. You need 370 million. So you have to see how we are going to get 370 million. So you have to organize. You have to organize this amount of money. Now, what are the sources you can use to get 370 million? What are the sources? What are the sources of money you can use for that?
Bank loan.
Yes, bank loans. Right. So since it is in
Investments.
business, you can apply for SME loans, bank loans. Yes, what else? Bank loans. What else?
Investments.
Now these are investments. You invest in land, building, machinery. Now you have to see how we are going to find 370 million. How we are going to raise 370 million. So one is bank loan. What else?
Partners.
I'm sorry, I couldn't get you.
Partners.
I don't clearly hear you. So one example is bank loan. Bank loan. You mean partners, right? Right. So owners can bring money. Yes, owners can bring money. Right. So if it is a partnership, partners can bring money. Right. If it is a company, now see if it is this, if this is a established company, and company is going to start a new factory. So if that's the case, company can issue shares. So that's we call equity. What else? What else? So if it is partnership, partners can bring money. If this is company, company can issue shares. Then all are equity. What else? If it is company, company can issue debentures. Company can issue debentures. Company can go for short-term loans like bank overdraft. Bank overdraft. So likewise, you have to see how you are going to get 370 million. 370 million. Now the example, you can go for leases, leasing facilities. Now to buy motor vehicle, you can go for a lease. Right. Now in this example, let's say land building, for land building you need 150 million. Let's say owners brought 150 million to buy land building. So equity 150 million. Let's say machinery and equipment acquired through bank loans. Then bank loans 120. Let's say machinery and equipment were acquired through bank loans. So bank loan then 120 million. Let's say motor vehicle through lease. You see motor vehicle 80 million, then your leasing facility 80 million. Let's say raw material and this cash balance you got through the bank overdraft. Bank overdraft. Right. Or short-term loans. Bank overdraft or short-term loans. Right. So this is organizing. We call it organizing. Right. Now, once you know the financial requirement, that's planning the financial requirement, you have to raise that required amount of money. So we call it organizing. 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 Right. Now you raise 370 million. So you have to allocate it to relevant resources. For example, you got 150 million through owners' money, through owners. So you have to allocate 150 million to land and building. So you buy land building with 150 million. Then you got bank loan, 120 million. So you have to allocate to buy machinery and equipment. Then leasing facility, from leasing facility you buy motor vehicle. Through bank overdraft and short-term loans, you buy raw material and you keep cash balance of 10 million. So this is directing. We call directing. Directing. Now you can start the operation because we have got 370 million from various sources. We call financial sources, financing sources. Now you see this example again. You got 150 million through various financial sources, financing sources, equity, bank loans, leasing, and short-term loans. Now you have allocated this financial or this amount of money raised to your financial requirements. So we call directly. Directly. Now you have the assets. Now you have these assets. You can start the operations. You can start the operations. Right. So you buy material. So once the material stock is over, you buy material. Right. Then you have the finished goods. Finished goods are sold. If finished goods are sold on credit, you have trade receivables. Trade receivables. From trade receivables, you get cash. You get cash. Now, if you buy material on credit, you have trade payable. So once you receive cash, you can pay the supplier. You can settle the trade payables. And you can pay the accrued expenses. Expenses payable. Expenses payable. So this is your operation. Right. This is your operation. Because once you have the resources, you can start the operations. You buy material. You see again, you buy material. Sometimes you buy material on credit. Then you have the trade creditors, trade payables. Then when the production is over, you have the finished goods. When the finished goods are sold, you have trade receivables. Later you receive cash from customers. Then using the cash, you can pay your supplier balances, trade payables, and expenses. So you can start the operations. Then after the end of the particular period, you compare the actual results, actual financial results, actual financial results with the expected financial results. For example, after the first month of the operations, you compare the actual financial results with the expected financial results. You compare these two. You see whether expected results were achieved or not. To see whether those expected results have been achieved or not. So we call it controlling. We call it controlling. So all are included in the financial management. Right. So you have to plan the financial requirement. You see again. You have to plan the financial requirement. Then you have to organize the required amount of money. Organizing. So once you have the money, you can have to direct to fulfill the relevant requirement. So in this example, once you get the money, you buy the required resources. So you allocate money to buy required resources. Directing. Then you can start the operations in this example. So after the particular time period, you do the controlling. So controlling means actual results are compared with the expected results. So you see whether plans are achieved or not. Right. So this is a broad picture of financial management. Right. So basically financial management is management of financial resources. So when you say management, that includes all four management functions. So with this example, you can have the idea. You can have the idea. So this is how four management functions are involved in this situation. Right. Any question? Right. So if you have any question, you can ask. Any question? Have you got an idea?
Perfectly clear, sir.
Understood,
So
sir.
how about others? How about others?
Understood, sir.
Right. Now, if you look at this example again, right? If you look at this example again, there are various decisions involved. So you have learned what financial management is. So it's management of money resource that includes four management functions. Now, if you look at this example again, you see there are various decisions involved. Right. Now you see, so when you start the business, so you need assets. You need assets. You need resources. Now listen to me very carefully. You need resources to start the business. You know resources are assets. You see there are long-term assets, non-current assets. So what are non-current assets in this example? What are non-current assets?
Land, sir. Land building.
Yes, land, building, machinery, very good. Equipment, motor vehicle. So these are non-current assets. Right. So you have to buy non-current assets. You have to buy these non-current assets. So when you acquire non-current assets, there are various decisions involved. For example, when you buy a land and building, you have to decide a location. You have to decide a location. So when you buy machinery, you have to decide the model of the machinery. You have to decide the capacity of the machinery. Are we going for a, for example, monthly capacity 10,000 units of production or 15,000 units of production. You have to decide the capacity. You have to decide the supplier. So are we going for a Japanese manufacturer? Are we going for a Chinese supplier? So when you go for a motor vehicle, again, similar decisions are involved. Now you see, there are various decisions involved when you acquire non-current assets. So we call such decisions investment decisions. Investment decisions. Now what is the idea? Investment decision? Investment decisions are decisions relating to the non-current assets. Right. Now, when you plan the financial requirement, you have to make investment decisions. You have to make investment decisions. So you have to decide the location of your factory. Location of your factory. You have to decide the type of machineries, the model, the capacities. Likewise, there are various decisions involved when you buy non-current assets. So we call such decisions investment decisions. Right. Investment decisions. Is that clear? Is that clear?
Yes, sir.
Right.
Yes,
Now
sir.
you see investment decisions are relating to non-current assets. Then you have to find money to buy non-current assets. Now what are the sources of money you have used to buy non-current assets? What are the sources of money you have used to buy
Leasing.
non-current assets?
Leasing, sir.
Equity,
Leasing.
bank
Yes.
loans, leasing.
Leasing. Very good. From equity financing. So these are the financing sources. From equity, you bought land building. You see? From the bank loan, you got machinery and equipment. Through a lease, you got motor vehicle. Now you see, these are decisions. Now you decided to raise 150 million through equity. You decided to go for a 120 bank loan, 120 million bank loan. And you decided to go for a 80 million leasing facility to buy motor vehicle. Right. Now you see, these are decisions relating to the financing sources. Now you have applied 3 financing sources: equity financing, bank loans, and leasing. So decisions relating to the financing sources we call financing decisions. Financing decisions. So these are financing decisions. Financing decisions. Now, what is the meaning of financial decisions? These are decisions relating to the sources of finance to buy non-current assets. Right. Now, you see, these financing decisions are to buy non-current assets. These financing decisions to buy non-current assets. Right. So you decided to go for equity financing to buy land building. You raise 120 million through a bank loan to buy machinery and equipment. You decided to have 80 million lease to buy motor vehicle, to acquire motor vehicle. Now you see financing decisions relating to acquiring non-current assets. You see financing decisions are relating to acquiring non-current assets. Have you got the idea?
Yes.
Is that clear?
Yes.
Now you see investment and financing decisions are related because both concern on non-current assets. Is that clear? Investment decisions are about what non-current assets you are going to acquire. Financing decisions are about how we are going to finance the non-current assets. Now you see the difference? Investment decisions are about what non-current assets you acquire. But financing decisions are about how you are going to finance those non-current assets. You see, both concern on non-current assets. Right. So when you start the business, when you start the operations, you see, you buy raw material, then raw materials are input into the production process, then you have finished goods. Then after sale of the finished goods, you have paid receivable. From the receivable, you get cash later on. Using the cash, you can pay your suppliers, you can pay your expenses. Right. So this is basic operations in your business. Right. Now you see there are decisions involved in these operating activities. For example, when you buy raw material, you have to decide the supply. For example, when you buy raw material, you have to decide the supplier. You have to decide the quantity of raw material. You have to decide the type of raw material. Right. Then when it comes to the finished goods, you have to decide quantity of the finished goods we are going to keep in the warehouse. So when you are selling finished goods on credit, you have to decide which customers you are going to give that credit. Because you are not selling all your products on credit. You are not selling products to all customers on credit. So you have to first evaluate the customer's credit worthiness. You have to see whether the customer can repay or not. So after an evaluation, you decide these are the customers you sell products on credit, and these we don't sell these customers on credit. So you have to decide who the credits are given. You have to decide the credit period. You have to decide the credit period. Right. So when it comes to cash, you have to decide how much cash you are going to keep in the bank account. Right. So likewise, now you see, in these operating activities, there are various decisions involved. So we call them liquidity decisions. Liquidity decisions. Or working capital management decisions. Working capital management decisions. Now you see, working capital management decisions are related to the day-to-day operations in your business. Have you got the point? So in our example, this is day-to-day operation active. These are day-to-day operating activities. So you buy raw material, then you input raw material to production, you get finished goods. Then when you sell the finished goods, you have trade receivables. From receivable later you get cash. From cash you can pay your supply. You can pay your expenses, day-to-day expenses like electricity, salaries, day-to-day expenses. So there are decisions involved in these operating activities. So I have given here some examples. So these decisions are called liquidity decisions or working capital management decisions. Right. So liquidity or working capital management decisions are related to day-to-day activities of the business. Day-to-day activities of the business. Right. Now you see, we have studied 3 types of decisions. You see again, investment decisions, financing decisions, and liquidity decisions. Liquidity decisions or working capital management decisions. Then after end of the particular period, you have the actual financial result. You do a performance evaluation as a part of controlling function. Then you decide whether owners are paid back or not. So if it is company, so how owners are paid back? What's the idea? If it is company, how we are going to pay back the owners? What's your idea? How are you going to pay back the owners?
Profits.
Yes, how we are going to give profit back to the owners? Very good.
Dividend.
Yes, dividend. Dividend. So you have to decide. Now, for example, let's say in the last financial year, your actual results shows a profit of 20 million. Now, as a part of controlling function, you compare the actual results with the planned results, expected results. So you have to decide how much you are going to pay back the owner as dividend and how much you are going to retain in the business. Because part of the profit you should retain in the business. You are not usually going to pay back the owner the entire profit. So you retain part of the profit because that part of the profit you can use for future investment. So for example, let's say you decided to pay 30% of the profit as dividend and balance 70% of profit you decided to retain in the business. So decisions relating to distribution of profit. This is distribution of profit. You decided to pay owners 30% of the profit as dividend. So this is distribution of profit. So decision relating to distribution of profit is called dividend decisions. Dividend decisions. Dividend decisions. Right. So financial management involves these 4 types of decisions. So when you manage financial resources, you can see these 4 types of decisions. You see, investment decisions. Now, what is the meaning of investment decision? Investment decisions are about
Purchasing the non-current
yes,
assets.
yes, very good. Investing long-term assets or non-current assets. Then what is the idea about financial decisions? Financing decisions.
How we are going to finance our non-current assets?
Very good. Very good. So these are decisions relating to sources of money to finance non-current assets. Then what is the meaning of liquidity decision or working capital management decisions? What is the meaning?
Decisions are related to day-to-day operations.
Yes, very good. Decisions are relating to day-to-day operations. Now, if you look at again this, you see from day-to-day operations, you have raw material, finished goods, trade receivables, cash. What are these? You have raw material stock, finished goods stock, trade receivables, and cash. What are these for?
Current
Which kind of
assets.
assets? Current assets. You see, current assets. These four are current assets. Raw material, current assets. Finished goods, current assets. Trade receivable, current asset. Cash, current assets. And trade payables, expenses payables. What are these? Trade
Current
payable?
liability.
Yes, current liability. Expenses payable?
Current liabilities.
Current liability. Now you see, in liquidity decision, you are focusing on current assets and current liability. Current assets and current liabilities. So in liquidity decisions, you are focusing on management of current assets and current liabilities. So by taking decisions, liquidity decisions, your concern is managing current assets and current liabilities arise from day-to-day operations. So that is a broad idea about liquidity decisions. So simply liquidity decisions are decisions relating to day-to-day operations. You see, from day-to-day operations, you see current assets and liabilities arise. So you take these decisions to manage those current assets and current liabilities. So that's why they are called working capital management decisions. Working capital management decisions. Is that clear? Is that clear?
Yes, sir. Clear.
Right. Then the fourth one, dividend decisions. Dividend decisions.
Non-current liabilities related, sir.
Yes. So these are decisions relating to distribution of profit. Distribution of profit to owners. If it is a company, this is the decision relating to dividend or distribution of profit to the company shareholders. Right. Now you see, when you do financial management, you are involved in these four types of decisions. So when you do financial management, now this is financial management. This is financial management. So when you do this, you are involved in these four types of decision. Right. Now, if you go through your PowerPoint presentation, you can later go through that, right? So you see these four decisions in finance, right? You can later go through this, right? You see four decisions in finance, right? Then objective or goal of financial management is wealth maximization. wealth maximization, right? Now you involved in 4 decisions. So your goal is maximization of wealth of the owners. Your goal is owners' wealth maximization. If it is company, your goal is maximizing shareholders' wealth. In a company, owners are shareholders. Then your goal is maximizing shareholders' wealth. But profit maximization is a kind of an inferior one, because it has some limitations. So this is an inferior one. More appropriate goal is owner's wealth maximization. Because profit maximization has some limitation. Right. Now, one main limitation is, now when you say wealth maximization, we are concerning on cash flows. We are concerning on time value of money. We are going to study those in our next sessions. We are concerning on the cash flows and its time value of money. But in a profit maximization, you are concerning on profits, not the cash flows. There's a difference between profit and cash flows. There are limitations in profits. One limitation is you can manipulate. You can manipulate. And there's no clear definition for profit. You see, there are various types of profit. You can remember in financial accounting, you calculated gross profit, you calculated operating profit, you calculated profit before tax, you calculate the profit for the year, after tax profit, you calculate the total comprehensive income. So there is no clear definition for a profit. And it can be manipulated. You can remember, you can change the depreciation and increase the profit or decrease the profit. You can change the accounting policies and manipulate profit. But cash flows cannot be manipulated. Now, which is more appropriate? Profit or cash flow? Cash flow. Right. And profit maximization does not concern on, ignore time value of money. Ignore the risk aspect. Ignore the risk aspect. Therefore, more appropriate goal is owner's wealth maximization. Owner's wealth maximization. Especially, it concerns on cash flows. It concerns on cash flows. It concerns on time value of money. So we are going to learn next. We are going to learn that concept next. It concerns on time value of money. And cash flows cannot be manipulated. Like profit. So unlike profit, cash flows cannot be manipulated. Right. So goal of financial management is maximizing shareholders' wealth. Now, if you go back to our example, so you take these financial decisions, investment, financing, dividend, and working capital management decisions. So at the end, your goal is, so by doing all these decisions, with all these decisions, the goal is maximizing owner's wealth. owner's wealth. So this is your goal. This is goal of financial management. Right. So this is basically your first session in the course material. So I have made you understand being of this session with this example. Right. So any question you have? Any question you have? So
Understood,
we
sir.
yes, we
For my
studied
side,
about,
sir.
yeah, right. Any questions? How about others?
No.
Right. So we basically studied what financial management is. And we studied 4 decisions in financial management. Then we studied goal of financial management. So it is owner's wealth maximization, not profit maximization. So with that, we studied limitations or why profit maximization is not considered as a goal. The limitations in profit maximization. Right. So that's basically your first session in your course material. Right. Now, next session is time value of money. So that's very important because it's related to that wealth maximization principle. Right. So remember, in your course material, sessions are organized because each, in a way, one session linked to the other session. Right. So you cannot go here and there in the course material and study. You have to start from the beginning. You have to start from the beginning. Right. So I have seen some students are studying the course material or this kind of a course by looking at some exam papers and seeing more appropriate or the more weights in the exams are given for these lessons, and they are starting with those lessons. Right. But for this kind of a practical course, you cannot do that. So when you study for the first time, you have to start from the first session. So with the idea about the course, you have to move on to the other sessions. Right. So we study, you see, time value of money is considered in wealth maximization principle, but it ignore, you see, in profit maximization. You see, it ignore in the profit maximization, but it's considered in the wealth maximization. Now we are going to study this principle, this concept, time value of money. So that's your second and third sessions. Right. So let's have an idea. Right. Time value of money. Now you see, money has time value. So time value of money means money has time value. Now, for example, now let's say you can have 1,000 rupees today, let's say from your parents. You can have 1,000 rupees today or in 1 month. Let's say you have two options. You can have 1,000 rupees today or in 1 month. So which one would you prefer?
Today, sir.
Today. So why do you prefer today rather getting it in 1 month?
Because it is depression.
Why 1 month, sir?
I'm sorry, I couldn't get you.
The
Because
value of the money can be changed by the time.
Yes. Any other idea?
Depreciate.
Depreciates. Now you think simply. So why do you prefer 1,000 rupees today rather than getting it in 1 month?
because of inflation or cost of living increasing, or
Yes, those are some. Yes. Any other idea? You simply think about that.
Purchasing
Why do
power.
you prefer? I'm sorry, I couldn't get you.
Purchasing power.
Right now, no, just simply think about that, right? So why do you prefer 1,000 rupees today rather in 1 month? Now, if you are getting 1,000 rupees in 1 month, right? Now you need 1,000 rupees to buy something. So you have to wait 1 month.
If the need is today, so I want that money today.
Yes. Yes. So if you have it today, you can fulfill your need today, right? But if you are getting in 1 month, get it in 1 month, you have to wait for 1 month. So you prefer 1,000 rupees today. One reason is early consumption. Early consumption. You can use it today. You prefer 1,000 rupees today. If you get it today, you can use it today. You can consume it today. So one reason is early consumption. What else? What else? What else? How about risk? Which involve risk? Getting 1,000 rupees today or in 1 month?
today, sir, because we can't predict, right? But after 1 month, it's happened. What happened, right?
Yes. The risky one is waiting 1 month to get 1,000 rupees. Right. But if you have it today, there is no risk. Because in 1 month, your parents' mind may have changed. Sometimes you may not receive. So another reason is risk. Risk. So if you have it today, there is no risk. You got it. Right. Another reason is
Satisfaction?
investment. Yes. Now all attached to satisfaction. If you get it today, you can consume it today. So you are satisfied. Right. And if you get it today, there's no risk. You got it. You are satisfied. So finally, you end up whether you satisfied or not. Right. Very good. So another reason is investment opportunities. Investment opportunities. Now, if you have it today, you can invest and increase that amount of money in 1 month's time. For example, let's say you can invest in, let's say, 12% deposit, right? Now, if you have it today, 1,000 rupees, you can invest for 1 month. So if the annual interest rate is 12%, monthly interest rate is 1%. Then 1,000 rupees, you invest for 1 month, then you get 1% interest. How much? 10 rupees. By the end of the month, how much your deposit value? how much your deposit value? 1,000 invested, interest received 10. How much your deposit value? 1,010. But if you got it in 1 month, so by the end of the month, you have only 1,000. So because there are investment opportunities, you prefer to have money early. You prefer to have it now because there are investment opportunities. Now you see, you prefer to have 1,000 rupees today, now, rather in 1 month. So these are basic reasons. These are basic reasons. Right. You prefer to have 1,000 rupees today, rather in 1 month. Now you see, amount of the money is same. You see, amount of the money is the same, but you prefer to have it today rather than 1 month. You see, money has time value. So in both options, whether you have it today or in 1 month, you are getting 1,000 rupees. Now you try to get the idea. In both cases, you get 1,000 rupees. But you prefer to have it now rather than in 1 month. The indication here is it has time value. It has time value. Right. Then we can say money has time value. So that's called in financial management time value of money. Time value of money. Have you got the idea?
Yes.
Any questions? Right. So when you study time value of money concept, so this is actually a principle. So when you study it, so you have to study two concepts. Future value concept and present value concept. Present value concept. So these two concepts you should logically understand. Right. So that's what I want you to do. Right. You should logically understand. Right. So you should carefully work out the examples I am giving now. So you should work out with me and try to get logical understanding. Right. So future value concept is your second session in your course material. And third session is present value concept. So these understanding of these two concepts are important for next few sessions. Session 4, 5, 6. Now you see, these two concepts are key, very crucial in the first few sessions. So what I want you to do is try to get logical understanding of these two concepts. Right. So let's start with future value concept. Right. So it is the value of money in some time in the future. Now this is today. The value of money sometime in the future, maybe in 1 month time, maybe in 1 year's time. 2 years time, 3 years time. Its value of money sometime in the future. Right. So we call future value. Right. Now let's start with very simple example. Now assume you have now 100,000. You have now 100,000. Assume you can deposit your money in a fixed deposit, in a deposit giving 10% annual interest. Assume you can deposit 100,000 at 10% annual interest. How much your deposit value in 1 year's time?
110,000.
Yes, 110,000. Right. So how do you get 110,000? Now you deposit 100,000 at the end of the year 1. So you are getting 10% interest on the deposit value. Then how much interest?
10,000.
10,000. So 100,000 into 10%. 10,000. Then interest is added to the deposit. 10,000. Then in 1 year's time, your deposit value 110,000. So at the end of the year 1, your deposit value 110,000. End of year 1, deposit balance 110,000. How much your deposit value in 2 years time?
120,000.
120,000. Any other idea?
121,000.
121,000. Now 10,000 interest you receive, you have invested in the deposit. So I didn't tell you that it's withdrawn from the deposit. You see, deposit value end of the first year in 1 year's time, 110,000. The meaning is that 10,000 interest you receive has been invested in the deposit, has been retained in the deposit. Then in the next year, you are getting interest not only for the initial deposit. You are getting interest for the interest you received in the previous year. So in the year 2, you are not only getting the interest for your initial investment. Your initial investment 100,000. Because that interest 10,000 is added to the deposit value. Then in the next year, in the year 2, you are getting interest for the initial investment plus interest you receive for the previous year.
11,000.
Yes, 11,000. Then you are getting, you see the calculation? You are getting interest for entire 110,000. Right. So 110,000 into 10%, 11,000. So how do you get 11,000? You are getting interest for the initial investment 100,000 and previous interest 10,000. Then total interest here 10,000, 1,000, total interest 11,000. So you see, you are getting interest on interest. Right? You are getting interest on interest. So in the second year, You are getting interest on this 10,000 interest you got in the last year. So you are getting interest on interest. We call it in financial management compounding. Compound interest, or simply compounding. Right. So when you calculate future value, you assume compounding. The future interest is calculated not only for the initial investment, but also for the interest you received in the previous years. So that technique we call compounding. Right. So when you calculate future value, you have to apply the compounding technique. Right. So your deposit value, so second year interest 11,000. Then your deposit value at the end of the second year, 121,000. Right. How much your deposit value in 3 years time?
133,100.
Yes. So in the year 3, how much your interest? You are getting interest of the
12,100.
yes, 12,100. Right. Now see how 12,100 is made up. Right. So that's how you logically understand. Your initial investment is 100,000. So you are getting interest on the initial investment. Your initial investment is 100,000. So you are getting interest on the initial investment, 10,000. And previous interest, year 1 interest 10,000, year 2 interest 11,000. Total interest you received is 21,000. So you are getting interest on that interest also. You are getting interest on that previous interest. Then how much? 2,100. Then total interest in the third year, 12,100. So this is compounding. So you are getting interest on the previous interest. You are getting interest on the previous interest. So we call compounding. So end of the 3 year, in 3 years time, end of the third year, your deposit value 133,100. Right. So we call them future value. So how much your deposit value in 1 year's time? How much your deposit value in 1 year's time?
110,000.
110,000. So we call it future value. Value of your investment in 1 year's time. Future value. How much your investment value in 2 years' time?
121,000.
121,000. So that is the value of your investment in 2 years' time. Future value. In 3 years' time? 133,000. Yes, very good. So that is the value of your investment in 3 years' time. So we call future value. Right. How much your deposit value in 10 years' time? Now you don't need to calculate one by one. Right. There's a model. Right. So future value equal. Now if you can calculate one by one, you can calculate the end of the 4th year value, 5th year value, 6th year value. Likewise, you can go up to 10 years. But you can apply a model. So future value equal initial investment we call present value. The today value of the investment, today value we call present value. 1 plus R to the power n. You can apply this model. You can apply this model. Right. So FV means future value. PV means present value. That is the today value of the investment. R is the interest rate. R is the interest rate. N is the time period. N is the time period. Now let's calculate the value of investment in 3 years' time. Let's calculate the value of the investment in 3 years' time. Today you invest 100,000, PV 100,000, 1 plus how much interest? 10%, 0.1. So you need value of the investment in 3 years' time. Then N is 3. Value of the investment in 3 years' time. So time period is 3 years. N is 3. Right. See how much answer? How much is the answer? See the answer? How much? 100,000 into 1.1 to the power 3. Right. You first get the 1.1 to the power 3. You first get the 1.1 to the power 3. How much? How much? 1.1 to the power 3. How much? 100,000 into 1.1 to the power 3. Now you need a calculator. Scientific calculator.
1.331.
Yes, 1.331. Then your investment value in 3 years' time, 100,000 into 1.331, 133,100. 133,100. So that's what we got here. 133,100. So how much your investment worth in 10 years' time? You quickly find out the answer. How much is the value of your investment in 10 years' time? Quickly get the answer. How much? How much? In 10 years' time. Then time period is in 10 years. 10 years. To the power n is 10. Then how much? 100,000 into 1.1 to the power 10. How much?
259,374
Yes.
2
Yes, very good. Very good. So how much 1.1 to the power 10? 1.1 to the power 10, 2.594. Let's take up to 4 decimals, 3 decimals. 100,000 into 1.1 to the power 10 is 2.594. 2.594. Then your investment value in 10 years' time, 259,400, almost 260,000. 260,000. Have you got the idea? Any questions?
Yes, sir.
Yes.
Clear.
Right. So future value is the value of your money sometime in the future. So you have to apply the compounding technique. So what is the meaning of compounding technique? What is the meaning of compounding?
Future value.
Now, what is the idea behind compounding?
Investment plus interest rate.
Yes, not interest rate. When you calculate the future interest, you calculate the interest not only on initial investment, but also
Interest
the
to
previous interest, yes, previous interest received. Right. That's we call compounding. Right. You know, there are situations. Right. Now here you are getting annual interest. Now in our example, you get annual interest. There are situations your interest period is less than a year. For example, sometimes when you deposit, let's say you have 100,000. Let's say you decided to deposit in a bank fixed deposit. There are deposits paying or
Monthly.
accumulating interest less than or accumulating interest for a period less than a year. Sometimes interests are added to monthly. Interests are added to your deposit quarterly. Sometimes interests are added to your deposit semi-annually. Then interest period is less than a year. So let's look at such an example, right? Now let's say our second example. So you should take down. So you should work out the examples with me, right? Let's say you have 100,000. Let's say you deposit 100,000. Annual interest rate 12%. Right. Annual interest rate 12%. Let's say you have two options. One is you can have interest annually. You can get interest annually. Or you can have interest semi-annually. Let's say you have two options. You can get interest annually, or you can get interest semi-annually. So what is the meaning of semi-annual? Semi-annually, what does it mean?
6 months period.
Yes, 6 months. In 6 months' time. So how many times you receive interest in a year?
2 times.
Two times. 2 times. Right. How much your deposit value under both options? If you are getting interest annually, how much your deposit value in 1 year's time?
112,000.
Yes, 112,000. Very good. Your initial deposit today, 100,000. Then at the end of the year, you are getting the interest for the entire year. 12% interest. Then how much interest? 12,000. 100,000 into 12%. Then deposit value, end of the year, 112,000. At the end of year 1. But in the semi-annual interest,
After
So if you are
first 6
getting,
months, you will be receiving 106,000.
yes, very good. Right, very good. So in the second case, if you are getting semi-annual interest, your deposit 100,000. Then for the first 6 months, interest for first 6 months, how much? 100,000 into 12% for the entire year. Then for 6 months, half. Have you got the point? 12% interest for the entire year. Then for 6 months, you get half of that, 6%. You get half of that 6%. Then your interest is 6,000. So first 6 month interest 6,000. At the end of the first 6 months, your deposit value 106,000. Then how much interest for the second 6 months? How much is the interest for the second 6 months? How much is the interest for the second 6 months? How much?
And for the 106,000, you have to calculate for the semi-annual amount.
Yes, very good. In the second 6 months, because we are applying the compounding. In the second 6 months, you are calculating interest not only for your initial deposit, but also for the interest you receive in the previous 6 months. So remember, when you calculate the future value, you have to apply the compounding. So interest for second 6 months. Interest for second 6 months. So you have to calculate for 106,000. 12% per year for 6 months. How much? How much?
6,360, the interest.
Yes, very good. 6,360. Then your deposit value at the end of the first year, 112,360. So at the end of the year one, your deposit value 112,360. Now you see, if you invest for annual interest, your deposit value 112,000. Now you have to logically understand, this is important, not merely the calculations. If you invest for annual interest, your deposit value 112,000. But if you invest for semi-annual interest, your deposit value is larger than that. Assume another situation. Let's say interest is paid quarterly. Let's say interest is paid quarterly. How much deposit value at the end of the first year? You calculate and see
103,000.
how much? I couldn't get you.
103,000.
I mean, at the end of the year, first year.
First year, sir.
Yes. You calculate and see. You are getting interest quarterly. Then your deposit 100,000. So interest for first quarter. Interest for the first quarter. How much? 100,000. Annual interest 12%. Then
3,086.
yes, quarterly interest is 1/4 of that. How much? 3,000. So how about others? Have you got the answer? 3,000 interest for the first quarter.
Yes, sir.
Yes,
Right.
sir.
Then at the end of the first quarter, how much your deposit value?
103,000.
103,000. Then interest for the second quarter?
3,030 for 103,000.
Yes. You have to calculate on 103,000 because every time, remember, you are applying the compounding interest. Right. So in the second period, you have to calculate interest for 103,000.
$3,090.
Yes, very good. 3,090. Then at the end of the second quarter, your deposit value 106,090. Then for the third quarter, interest for the third quarter.
Interest for third quarter is 3,182.7.
Yes, very good. So you have to calculate interest for 106,000, 106,090. $3,183.
It's approximately 80.
Yes, very good. Then end of the third quarter, your deposit value 109,273. Then interest for the fourth quarter. Interest for the fourth quarter. How much? Interest for the fourth quarter.
3,278.9.
Yes, 3,278. So let's take 78.
79 we can be take, sir.
Then at the end of the fourth quarter, right? Now it's 78.19. So you can round up and take 78, right? Then end of the fourth quarter, your deposit value. How much? How much? So 1 minute, please.
$112,551.
Yes, 551. So end of the fourth quarter means end of the first year. End of year one. $112,551. Now you see this is larger than even semi-annual interest. You see, if you are getting semi-annual interest, your deposit value at the end of the first year, 112,360. But if you are getting a quarterly interest, your deposit value is 112,551, larger than the semi-annual interest. Now you see, when the interest period is lower, you get higher deposit value. Right. Now let's take 3 situations. So let's say this is
Isn't
yes.
it a drawback for the financial institution? It will be really a benefit for the depositor. What about the lender?
Yes, that's a good question, right? Because lenders decide because lenders know that, right? So depositors are getting higher interest. Then if the interest period is lower, they will reduce the interest rate. Right. So I'll be coming to that point, right? I'll be explaining that.
Okay.
Right. So let's take these three situations. In the first situation, now in all three situations, you have the same deposit. In the first situation, annual interest. Annual interest. Then how many times in a year interest are added to your deposit? If it is
One.
annual interest, one.
One.
So, yes, one. We call interest payment frequency. We call it interest payment frequency. Interest payment frequency. So in the first case, annual interest are paid, then only one time interest is added to the deposit in a year. Then how much your deposit value? Deposit value 112,000. Right. So in all three cases, annual interest rate same, amount of the deposit same. In the second case, interests are paid semi-annually.
So twice a year.
Yes, very good. Semi-annually. Semi-annual interest. Then interests are added to your deposit 2 times in a year. Then how much your deposit value? 112,360. In the third situation, you are getting quarterly interest.
So 4 times your interest.
Yes, very good. Quarterly interest. So interests are added to the deposit 4 times. Then your deposit value 112,551. Right. Now you see, when the interest frequency get increased, your deposit value increases. Right. So you are getting, when the interests are receiving more frequently in a year, you are getting higher deposit. Your deposit value increases. Right. Your deposit value increases. So in all three cases, annual interest rate, 12%. In all three cases, annual interest rate 12%. Right. So that we call nominal interest rate. Nominal interest rate. You better take down this. In all three cases, nominal interest rate 12%. So I'll be taking at the beginning. In all three cases, nominal interest, you better take down this. Nominal interest. Annually 12%. Nominal interest rate 12%. Right. But when the compounding frequency or interest payment frequency increases, the deposit value increases. Deposit value increases. Right. Now, practically, now let's say you have two options to deposit your money. Let's say one is annual interest, second one quarterly interest. So bank reduce interest rate for the quarterly interest. Right? Usually lower interest rate for a quarterly interest. Right? So interest rate will be lower for quarterly interest because interests are compounded. The depositor receive higher interest. Right? Depositors receive higher interest. Right? So lower interest for the quarterly interest payment deposits than the annual interest payment deposit. Right? You don't see same nominal interest rate for both the annual interest payment deposit and quarterly interest payment deposit. Usually, nominal interest rate for quarterly interest rate payment deposit lower than nominal interest rate for annual interest payment deposit. Right? Have you got the idea? Have you got the idea?
Yes, sir. Clear.
Yes, thank you.
Right. Right. So you can apply the same compounding formula to calculate this kind of deposit value in this kind of situation. Right. Now, what is the formula? Future value formula. Future value equal today value. We call PV, present value,
Yeah, 1 plus R and the power of.
to the power n. Right. Now let's calculate for 3 situations. In the first case, you apply the formula and calculate. Future value. Here, future value means value of the deposit in 1 year. Value of the deposit in 1 year. Let's say FP1. Today you invest 100,000. 1 plus R. Now, in the first case, you see annual interest payment.
Zero 0.03.
Annual interest payment. Right. Now, if it is annual interest payment, R is annual interest rate. N is interest payment is in 1 time. At the end of the year, N is 1. Then how much deposit value?
112,000.
112,000. Right. In the second case, semi-annual interest payment. Now you apply the formula and calculate. In the second case, that is the semi-annual interest payment. Semi-annual interest payment. You apply this formula and calculate. FV1 equal 100,000. 1 plus. Now can you take 12%?
No, 0.06.
Yes. So R, remember, you should write down. R is interest rate for an interest period. You should write down. So here R is interest rate not for every time for a year. Interest rate for a interest period. R is interest rate for an interest period. Now, if interests are added semi-annually, your interest period is 6 months. Your interest period is 6 months. Then you have to take R 6-month interest rate. Annual interest rate 12%, 6-month interest rate 6%. So R is 6%, 0.06. Then N is number of interest payment period during the deposit period.
Then 2.
Now, yes, 2. Now your deposit period is 1 year. Semi-annual interests are paid. Then how many interest period during that interest investment period? 2. So N is 2. Right. So you better write down. N is number of interest payment periods. N is, you better write down, number of interest payment periods. Number of interest payment periods during the investment period. You better take down this. Number of interest payment periods during the investment period. Number of interest payment period during the investment period. Now your investment period, 1 year. So interest are paid 2 times. Right. Interest are paid 2 times. Then N is 2. R is interest rate for a interest payment period. So semi-annual interest. So interest are paid once in 6 months. So interest payment period is 6 months. Then you have to take 6-month interest rate. Annual interest rate is 12%. Then 6-month interest rate is half of that, 6%. Right. Now you calculate and see how much your deposit value. You calculate and see 100,000 into 1.06 to the power 2. How much?
112,360.
Yes. 112,360. Then quarterly interest. Third situation. Interests are paid quarterly. Quarterly interest payment. Now you apply the formula and calculate. You apply the formula and calculate. Future
Yes.
value 100,000 into 1 plus how much R?
0.03.
Yes.
0.03.
Yes. 3%. R is interest rate for an interest period. So if it is quarterly interest payment period is a quarter. Annual interest rate 12%. Then quarterly interest rate is 1/4 of that. 3%. 0.303. N. Number of interest payment period. So investment period 1 year. If the
N will be
quarterly, yes, if the quarterly interests are paid, number of interest payment period is 4 to the power 4. How much? 100,000 into 1.03 to the power 4. How much? 112,000.
551.
Yes, 551. Right. Any questions up to now? Any questions?
No, sir.
Understood, sir.
Right. Now here one more thing you should understand. Now in all 3 cases, nominal interest rate same. Nominal interest rate 12%. But investors are getting higher deposit value when the interest payment frequency is higher. So all three cases, nominal interest rate is 12%. But when the interest payment frequency is higher, investors are getting higher investment value. Then what happens is investors are effectively getting higher interest. That's why investment value increases. Right. So you have to learn the concept called effective interest. Effective interest. Effective interest. You see, in the quarterly interest payment, you have the highest investment value because interests are added to the deposit quarterly. The meaning is investors of this quarterly deposit situation receive higher interest, effectively receive higher interest than the other two situations. Right. So you have to learn this concept, effective interest. So nominal interest, 12%. Nominal interest, 12%. So this is how effective interest is calculated. 1 plus, let's say nominal interest are N. Right. So let's see what's given in your study material. I, nominal interest, is referred to as I in your study material. Right. So you can say nominal interest. Now, symbol given in your study material is I. Right. I. So let's say nominal interest is I. Right. Or you can say Rn Y. I is nominal interest. Right. So 1 plus nominal interest divided by number of interest payment during a year. Number of interest payment during a year. Let's say M. M is number of interest payments during a year to the power M. To the power M. Right. Now you don't have to remember this formula. Right. Now, if you look at the semi-annual case,
What is representing M, sir?
M is how many times interest are paid during a year. Right. Now,
Yes,
forget
sir.
about the formula. Yes.
In the
Forget about the
previous,
formula. You don't. Yes. You don't want to remember the formula. You can logically think and calculate. Right. So 1 plus nominal interest rate 12%. Divided by, let's say, semi-annual case. Let's take semi-annual case, semi-annual interest. Semi-annual interest. Right. So nominal interest rate 12%. So in semi-annual interest, how many times interest are paid during a year?
twice.
Twice. Divided by 2 and to the power 2. To the power 2. So that is the effective interest. Now C, effective interest rate. C, effective interest rate. C, effective interest rate. Right. How much? So deduct 1, then you are getting the percentage. 1 plus 12.12 divided by 2, 06.06 to the power 2. From the answer, deduct 1. 1.06 to the power 2, deduct 1. How much? How much? How much? 1.1236 minus 1, you are getting 0.1236 percentage, 12.36. Have you got it?
Yes, sir. Yes.
Right. Now let's see the quarterly case. Quarterly interest payment. How much is the effective interest rate? Effective interest rate.
12.5.
Yes. 1 plus nominal rate divided by how many times the interest is paid? 4 times. To the power 4. From the answer, deduct 1. 1 plus 0.03 to the power 4 minus 1. How much? So here we are getting 1.2125. Is it 55?
Yes, sir.
Yes, sir. 5.
Minus 1. Then 0.1255. Have you got the same?
Yes, sir.
Right. As a percentage, 12.55. Right. Now you see, effective interest rates are different. Right. So when the interests are paid annually, effective interest is the same. But when the interests are paid semi-annually, effective interest rate, how much? 12.3. How much have we got? 36.
36, sir.
But quarterly,
12.55.
12.55. Now you see, nominal interest rate same. Now you have to understand this very clearly. Nominal interest rate same. The difference is interest payment periods. So when the interest payment periods, number of interest payment period increases, effective rate increases. So that's why investors are getting higher deposit value with higher interest payment period, higher interest payment frequency. Right. Now you see there's a difference between nominal interest rate and effective interest rate. So when you invest in a deposit, you should look at the effective interest rate. That is the idea you should get, not the nominal rate given by the bank. So when you invest in deposit, you have to calculate and see effective interest rate. Then if you have number of options for a deposit, you calculate effective rate for each option and compare, select the option with the higher effective rate. In the meantime, you have to consider risk also. Right. So remember, when you invest in deposit, you should consider effective rate, not the nominal rate. Now you know how to calculate the effective rate, right? Right. So this is about future value concept. Right. Any questions before moving to the next session?
No, sir.
Nothing. Yes. Any question?
Yes, sir.
Now, shall we work out one more example before moving to the next session? Right. Now, let's say you have 200,000. You deposit quickly. We'll work out this. You deposit 200,000 today at interest rate 12% for 3 years. So you deposit today at interest rate 12% for 3 years. Interests are paid quarterly. Interest is paid quarterly. How much is the deposit value at the end of the 3rd year? So you have to calculate deposit value at the end of the 3rd year or in 3 years' time. How much is the deposit value in 3 years' time? Quickly get the answer. Quickly get the answer. Quickly you get the answer. So you have to calculate future value in 3 years' time. Value in 3 years' time. Today value 200,000. Today you deposit 200,000. Now you see the formula. PV into 1 plus R to the power n. Now what is R? R is
0.03. Yeah, okay.
yes,
Part.
R is that's we have to very clearly understand. Interest rate for an interest period. Interest rate for an interest period. Now here interest period is a quarter. Annual interest rate 12%. Then quarterly interest rate. Annual interest rate 12%. Quarterly interest rate 3%. Then what is N? What is N?
It means the number of the periods how the interest payment is done.
Yes, number of interest payment periods
Yeah.
during the entire investment period. Number of interest payment period. Now your investment period 3 years.
So it will be
How
12.
Yes. How many times interest paid in a year? 4 times.
4 times.
4 times in a year. Interest paid investment period is 3 years. Now you see, interests are paid 4 times in a year for 3 years. The number of interest payment periods is 12. Now you can substitute the values. 200,000, 1 plus 3% to the power 12. How much? How much is the answer? How much? How much? Quickly get the answer. Is it 285,152? Have you got this? 285,152?
Yes, sir.
Right. Right. So that's about future value concept. Now we are moving to the present value concept. That's your session 3. Present value. So this is today value of a future cash flow. You know the future cash flow, you get the today value. So this future value formula, you can rearrange for the present value formula. Right. Now you see future value. How do you calculate? Future value equal present value 1 plus r to the power n. Now we know the future value. We know the future value. You have to calculate the present value. So this future value formula model, you can rearrange to a present value model. Present value formula. So present value equal, now this 1 plus r to the power n, you take to the left hand side. Then multiplication of 1 plus r to the power n become a division. So future value, present value equal future value divided by 1 plus r to the power n. Have you got this? Is it clear? Present value
Yes.
equal future value, or you can write down future value multiplied by 1 divided by 1 plus r to the power n. 1 divided by 1 plus r to the power n. Right. So here we are calculating future present value of a future cash flow. The future cash flow is known. We are calculating the present value. So present value equal future value multiplied by 1 divided by 1 plus r n. Right. Now this is called discount factor. You should learn the terms. We call it discount factor. Discount factor. Right. Now let's do example. Let's do example. Now let's say you will receive 10,000 in 2 years. Right. Let's say you will receive 10,000 in 2 years. How much present value of this 10,000? Present value of rupees 10,000 receivable in 2 years. You calculate. So example is you calculate present value of rupees 10,000 receivable in 2 years. Let's say R 10%. Let's say R 10%. Right. Now you substitute the values to the formula and calculate. PV equal future value into 1 divided by 1 plus R to the power n. So future value 10,000. You see 10,000 is receivable in 2 years. So future value is 10,000. Multiplied by 1 divided by 1 plus R 10%, 0.1. N is, you see, receivable in 2 years. In 2 years, N is 2. N is 2. How much? 10,000 into how much? 1 divided by 1 plus R to the power n. How much? 1 divided by 1 plus 0.1 means 1.1 to the power 2. 10,000 into 1.1 divided by 1.1 to the power 2. How much? 0.826. Have you got it? 0.826.
Yeah.
Then how much? 8,260. Have you got this? 8,260.
Yes.
Right. So this 0.826 is a discount factor. So it is discount factor. So this 0.826 we call discount factor. Right. So in now compare with the present value. Sorry, future value. In a future value calculation, you apply compounding. Your cash flows are compounded. But in a present value calculation, you apply discounting. So you are using discount factor to discount, to do discounting, to discount the cash flows. So you can remember, in the future value calculation, we applied the compound. Cash flows are compounded to get the future value. But here, when you calculate the present value, you apply the discount. Cash flows are discounted to get the present value. Right. Have you got the difference? So let's do one more example. Right. Example 2. Calculate present value of rupees 50,000 receivable in 5 years. R equal. R is the rate. We call discount rate. Because we apply here discounting. Then the interest rate is the discount rate, R is the discount rate, or you can say interest rate. Let's say R 12%. R 12%. Then how much present value? Quickly calculate. Future value into 1 divided by 1 plus R to the power n. Quickly get the answer. Quickly get the answer. So 50,000 is receivable in 5 years. So future value 50,000. R is 12%. 1 plus 0.12. You see, in 5 years, you are getting 50,000 in 5 years. N is 5. How much? How much? $50,000 into how much discount factor? How much is the discount factor? How much? How much? Discount factor? So with your scientific calculators, you can calculate. Is it 0.567?
Yes, sir.
Right. Then present value. 50,000 into 0.567.
28,371.
Yes. 28,350. So if you take all the decimals, then answer bit change. Right. Now you see, the cash flow is 50,000. You multiply it by 0.567. That is the discount factor. So this is the discount factor. So what here happens is discounting. You see, 50,000 was multiplied by discount factor. So we call it discounting. Cash flows are discounted. So we call this discounting. But when you calculate future value, you apply compounding. You should see the difference. Right. So when you calculate present value, you take the cash flow multiplied by discount factor. Take the cash flow multiplied by discount factor. So we call it discounting. Right. Any questions?
No, sir, understood.
Right. Now, so far, we were looking at future and present values of one cash flow. So we considered only one cash flow. But there could be a situation you see a series of cash flows. Right. There could be a situation you can find series of cash flows. Now, for example, let's say right. So let's take a simple example. Right. Now let's say you are going to do an investment. You are going to do an investment. So your investment period is 4 years. So this is now your investment period is 4 years. End of the first year, you invest 10,000. End of the second year, you invest 10,000. End of the third year, you invest 10,000. End of the fourth year, you invest 10,000. Now you see, you have a series of cash flows. You see amount of the cash flows here. Now you have to listen to me very carefully. Now you see your investment involves a series of cash flows over the next 4 years. End of the first year, 10,000. Second year, third year, fourth year, 10,000 each. Amount of the cash flow same. You see? Amount of the cash flow same. End of each year, 10,000 is invested. Then you see time gap from one cash flow to the other same. First cash flow in 1 year. Second cash flow in another 1 year's time. You see the time gap? Third cash flow is in another 1 year's time. You see the time gap? Fourth cash flow is in another 1 year's time from third cash flow. You see time gap between cash flows are the same. Time gap between cash flows are the same. Right. Now you see amount of the cash flow, same amount of cash flow. Second one, time interval between cash flows, same. Right. Same amount of cash flow over the investment period. Now listen to me very carefully. Time interval between cash flows, same. First cash flow in 1 year's time. Second cash flow is in 1 year's time from the first cash flow. Likewise, you have annual cash flows. Time interval between cash flows, same. Third one, you see cash flows for a certain time period. Cash flows are for a particular time period. Certain time period. Now here, all the cash flows for 4 years. So when these three characteristics are there, we call this cash flow series as annuity. Now, what are the three characteristics of an annuity? You have to clearly understand. What are three characteristics? Same cash flow. Amount of the cash flow, same over that period. Second one, the time interval between one cash flow to the other one should be the same. Then third one, cash flows are for a certain time period. Is that clear? Is that clear?
Yes.
Right.
Yes.
So when these characteristics are there, when all three are there, we call that cash flow series. Now this is the cash flow series. So we call it annuity. We call this cash flow series annuity. Now you should know how to calculate future value of an annuity and present value of an annuity. Right. Now you have a cash flow series annuity. Right. To calculate the future value of an annuity, this is the model. Future value of an annuity, FVA, let's say FVA, future value of an annuity, equal the cash flow, one cash flow, right? One cash flow multiplied by, now this model is in your course material. You can go through the course material or take down this. 1 plus the interest rate. You can say ROI, R, or you can say I, to the power n minus 1 divided by interest rate, right? So interest rate, you can say I or R, right? Earlier, I was using R, but according to your course material, I can remember interest rate is given by I, right? So this is the model. Right. Now let's calculate for the previous example. Now cash flows, you have 10,000 each for 4 years. Let's say interest rate 6%. R is 6%. Now calculate future value. Let's say interest rate I is 6%. Then future value, cash flow 10,000. Cash flow 10,000. 1 plus I is interest rate 6%. N. So how many years you are getting, how many periods you are getting cash flow? You see 4.
4.
4 to the power of 4 minus 1 divided by interest rate. See how much the answer is? See how much the answer is? How much? 10,000 into how much is the value of this? Now you calculate, because you should practice calculating this. How much? Quickly get the answer. So here 4.375. I've got it. Have you got the answer?
Yes, sir.
So how about others? Have you got the answer? How about others? Have you got the answer? Right. So this is future value of an annuity. Similarly, you should know how to calculate present value of this annuity. Now, your annuity is, you see, we'll go back to the previous example. So, end of each year, cash flow is 10,000. End of each year, cash flow is 10,000. End of each year, cash flow is 10,000. Right. So, present value of this annuity is value of this cash flow today. 0 is today. So, present value of the annuity means the value of all these cash flows, today. Value of all these cash flows today. Value of all these cash flows today. Right. So we call present value of the annuity. So you can calculate one by one. Present value of 10,000. Present value of second year 10,000. Present value of third year 10,000. Because we know the present value calculation for one cash flow. You can calculate one by one and add together. You can calculate one by one and add together. Or you can apply this model. Right. So present value of annuity equal cash flow multiplied by 1 divided by 1 plus I is the interest rate. Right, sorry. So we'll write down this way. 1 minus 1 plus I to the power n divided by R. Right. So you can apply this model. Right. So rather than calculating one by one to get the today value, you can apply this model. Right. So let's say I 6%. Now try to substitute the values and calculate. Cash flow 10,000 multiplied by 1 minus 1 divided by 1 plus interest rate 6% to the power 4, because cash flows are for 4 periods. N is 4 divided by, not R, interest rate I have given as I. Sorry, interest rate I divided by interest rate. Right. So you have to practice calculating these because these are very important in our next 2 sessions. Right. How much? Present value of this annuity. 10,000 into how much? So calculate and see the answer for this. How much? Now you have the scientific calculators. You can calculate. How much? How much? How much?
3.465.
How much? 3.465.
465.
Yes, 3.465. Sorry. So I need to share the screen, right? $3.465. Then future value of the annuity, present value of the annuity, 34,650. Right. Any questions?
No.
Right. Now you should remember this future value of the annuity and present value of the annuity. Because there are some practical applications from these models, from this formula. Right. There are some practical
Will it be
applications.
given the formulas or we have to memorize the formulas?
Now I'm not sure because this is the first time we are offering this course. Right. So I'll talk to the coordinator and let you know next time. Right.
Okay, thank you.
Right. Because I'm not the coordinator of this course. Right. I'll talk to the coordinator and let you know. Anyway, it's easy. You can, when you practice example, automatically that will be remembered. Right. So you have to practice. Right. You have to keep on practicing. Right. Because there are some practical applications like this. For example, now let's say, right, you think about a bank loan. Think about bank loan. So usually bank loans are paid monthly, repaid monthly. Let's say to simplify our example, let's say you are applying for 5-year bank loan. Let's say installments are paid annually. Let's say today you get the bank loan. It's a 5-year bank loan. 5-year bank loan. Annual installments. So repayments are annual. Annual repayments, or you can say installments. Annual installments. Let's say interest rate 10%. Annual interest rate 10%. Let's say you are applying for this bank loan. Let's say you need 100,000 loan. You need 100,000 loan. Now listen to me very carefully. This is really a practical example. Let's say you are applying for rupees 100,000 loan. Because you need 100,000 loan. So bank loan period 5 years. Repayments are annually. Interest rate 10%. So today you are getting 100,000. If the loan is approved, today you are getting 100,000. Now think about the repayments. Is it annuity? You think about the repayments. Is it annuity? Now see whether these three characteristics are there. What are three characteristics of annuity? Amount of the future cash flow should be the same. In a bank loan, how about installment usually? Is it same in every period? What's your
Yes.
experience? Yes. So every period you pay the same installment. Then your repayment cash flow is the same. Second characteristic, is it there? Time interval between one repayment to the other, is it same?
Yes.
Yes. Now in our example, loan is repaid annually. Then time interval from one installment to the other payment, the next installment is 12 months. If you are paying bank loan monthly, the time interval from one installment to the next is 1 month. Now in our example, second characteristic is also there. Third characteristic, is it there?
Yes.
What do you think? Yes. Because bank loan period 5 years, then repayments are only for 5 years. So cash flows are only for a certain period. Right. Now you see, if you look at the loan installment value, it is an annuity. It is an annuity. Right. So end of each year, let's say loan installment is X. End of each year, you are paying the same installment. Let's say loan installment is X. End of each year, you are paying the same installment. So this is annuity. This is annuity. Amount of the installments same, time interval same. Installments are paid only for 5 years, only for a certain period. You see, this is annuity. How much present value of this annuity? How much is the today value of the annuity?
100,000.
100,000. So we know the present value of the annuity, PVA. But we don't know the annuity value. Now can you calculate the annuity value? We know the present value of the annuity. But we don't know the X value. We don't know the cash flow value. Can you calculate the cash flow in each year?
No.
Now, what is the formula for present value of the annuity? Present value of the annuity equal cash flow multiplied by 1 minus 1 divided by 1 plus I to the power n divided by, I. This is how you calculate the present value of the annuity. You see, we know the present value of the annuity. So what we don't know is the cash flow value. That is X. We don't know X value. Can you calculate the X value? Can you calculate the X value? Can you calculate the X value? Right. Present value is known. Present value is 100,000. Present value is 100,000. We don't know the cash flow. That is the X value. 1 minus 1 divided by 1 plus. You see annual interest rate 10%. I is 10%, 0.1 to the power n. It is 5-year bank loan. 5 installments are paid. Divided by 10%. Now, can you get the cash flow value. 100,000 into 100,000 equal cash flow multiplied by, how much is the answer for this part? Quickly calculate and see. How much is the answer for this part? How much? How much? How much? Is it 3.791? You take up to 3 decimals. Is it 3.791?
Yes, sir.
Right. Then you can find X value, cash flow value. So how much cash flow value? So cash flow value equal 100,000 divided by 3.791. How much? 26,378.
6,376.26. Yeah.
70. So what is this cash flow value? What does it mean? These X values. These X values.
One
So first,
installment, the amount you have to pay.
yes, this is installment value. So cash flow value means the value of the installment. Installment value. Installment value. So 26,378. So first year installment, second year installment, third year installment, fourth year, and fifth year. Right. Now, when you apply for a bank loan, if you know the interest rate, if you know the loan period, usually monthly installments are paid. You don't need to ask from the bank how much monthly installment. You don't need to ask. You can calculate. You don't need to ask from the bank. You can calculate by yourself and check with the bank. Right. So after learning this, so that's your value getting from this session. Right. So if the bank says 10% interest, if the loan period is 5 years, now in this case, we have taken annual installment. But usually installments are paid monthly. Right. If it is annual installment, each year installment value is 26,378. So you don't need to ask from the bank. Right. Any questions?
No,
How about others?
Understood, sir.
Yeah. Right. Now, if you move on to a very practical situation, because usually banks are charging a monthly installment. How we are going to change this if it is monthly installment? If it is monthly installment, right? Because usually you have to pay monthly. Yes. If it is monthly installment, I should be 1 month interest rate. I should be 1 month interest rate. Then 10% divided by 12. Have you got the point? If it is monthly installment, interest rate, here we apply interest rate, monthly interest rate, then 10% divided by 12. This 10% also divided by 12. So you apply monthly interest rate. Then N, is it 5?
No, it will be then 60, right?
60, very good. It will be 60 because if it is monthly interest rate, you have to take how many months in the loan period? 5 years, the number of months, 5 into 12, 60. Then you are getting the monthly installment value. You are getting the monthly installment value. Right? So hereafter, you don't need to ask from the bank when you apply for a loan, how much my monthly installment. Right? You can calculate by yourself. You can calculate by yourself. So that's how you apply this learning to your day-to-day life. Right? Right. So we completed the first 3 sessions. Right. So this understanding, especially present and future values, this understanding is important to our next 3 to 4 sessions. Right. It's very important in the next 3 to 4 sessions. So before coming next time, you should practice, especially present and future value calculations. Right. So you should practice again these examples I gave you now. And you should practice the examples, activities in your course material. So before the next session, so next session is in next week. So before that, you should practice. Otherwise, you won't understand the next session. Next few sessions, right? Right. So anything you want me to clarify before winding up the session?
Thank you.
Right. So remember, you practice and come to the next session. Because from the next 3 to 4 sessions, you are getting your take-home assignment. Right. The next 3 to 4 sessions are very important. Today, I developed a foundation for the next 3 to 4 sessions. Right. Anything you want me to clarify?
No, sir. Thank you so much, sir.
Right. Then I will wind up the class. Right. See you next time.
See you, sir. Thank you.
Thank
Thank
you,
you,
sir.
sir.
God bless you.
You're welcome.